Hi friend, this is Peter Bain, founder of ForexMentor.com. Thank you very much for taking the time to go through this video tutorial. And what I want to talk to you about is good trades versus bad trades. Starting off with some high-level comments before we get into the charts themselves. It's very important that you pick the right pair to trade. I see people trading the euro or the pound or the Swiss franc with no rhyme or reason. The bottom line is you don't want to fall in love with a particular pair. You want to pick the right one to trade and for the right reasons. We'll get into that a bit in a minute. Beyond that, you want to make sure that you're exercising good technical trading skills. Certainly never try to force a trade. If a trade is not obvious, then take a pass on it and wait for one for a better one to come along. By all means, put your emotions in your hip pocket. Now, let's have a look at the USD CAD 4-hour chart, June 13th, 2011. You can see here we have three green lights. We have this common sense trend line here encapsulating the upper reaches of price action, the upper reaches of the shadows or wicks of the candles. Common sense trend line broken right there, confirmed by MACD punching up through its trigger line. And we have a spinning top right here. So we have three green lights suggesting that this is a good place to enter the trade. Now, it is sometimes asked of me, well, how long do you stay in a trade? How do you do a price projection? Well, what I recommend you do is let MACD solve that problem for you. For example, we entered the trade back here, and we're getting out here with a profit of 173 pips because MACD took us in down here and took us out up here. You always want to hold the trade as long as you have angle and separation between MACD and its trigger line and MACD not punching through its trigger line. So there you go. There's trade one. Now, I don't want to talk about short selling opportunities here because if you're an experienced trader, you will recognize those on your own. I want to talk about trading the trend. We are in an uptrending market here on the 4-hour chart. You can see the golden cross here, the 50 EMA punching up through the 200 EMA. That in Japanese trading circles is very bullish. Trade number two, right here, same idea, three green lights. We have a common sense trend line encapsulating the upper reaches of the shadows or wicks of the candles. Trend line broken right there, confirmed by MACD punching up through its trigger line. Again, the question is how long do you hold onto the trade? And the answer is as before. Just let MACD do that homework for you. Before I change slides here, I want to remind you that what we're in effect doing here is buying the weakness in the uptrend, buying the dips in the uptrend. There's a dip there. You always want to buy weakness because when you put your stop on 20 to 30 pips southward in each case, you won't get stopped out because you're buying weakness. If you buy a little bit higher and put your stop on, more than likely you're going to get stopped out. So, getting back to the notion of price projection, again, we got in here because MACD confirmed that that was a good trade, and we're getting out here with a profit of 74 pips because MACD has now punched down through his trigger line. And the concern I would have here is, what's going to happen next? Yes, we're in an uptrend. The 50 EMA is above the 200 EMA. Good angle and separation. Is this going to be an uptrend reversal pattern or an uptrend continuation pattern? We really don't know. I don't really care. I just want to grab my 74 pips as delineated by MACD. My focus during this presentation is to talk to you about trading the dips in the uptrend with the USD CAD pair. 4-hour chart here. And so I'm not going to talk about short selling opportunities. If you're a seasoned trader, you'll see those for yourself. As I said before, not knowing whether this was going to be an uptrend reversal or uptrend continuation pattern, we let MACD take us out of this particular trade that we took back here for a profit of 74 pips. Good move, because this pattern turned out to be an uptrend reversal pattern. Had we bought here, not gotten out here, and hung on, we would just be back to square one here. So it was a good move to cash in our chips and take our 74 pip profit back here. Now, trade number 3, I guess it is, over here, we're still in an uptrending market, the 50 exponential moving average above the 200 exponential moving average. We have a common sense trend line right here encapsulating the upper reaches of the shadows of wicks of the candles. Trend line broken right there, confirmed by MACD punching up through its trigger line. We're in an uptrending market as evidenced by the 50 EMA above the 200 EMA. So we have our 3 green lights as delineated on your screen. And again, our price projection is going to come in the form of paying attention to MACD. Here we have MACD above its trigger line. At no time did it punch down through its trigger line. So we would jump on the trade here and hold it all the way through to the end. This turned out to be an uptrend continuation pattern. You don't really know how to read, you don't need to know how to read those patterns. I'm just telling you what this is. Fibonacci experts would probably also see that this could very well be the 38.2% Fibonacci retracement level, and this the 27% Fibonacci extension level. You don't need to know that technobabble as long as you understand that we got in here, we followed MACD all the way up as long as MACD was above its trigger line. Let's just take a break here and talk about what we've learned. You should always trade a pair that is trending well. Then buy the dips in the uptrend or sell the rallies in a downtrend. And whatever you do, friend, never fall in love with a pair. Pick a pair that is trending well and you'll do just fine. Don't trade a pair because somebody else is trading the euro or somebody else likes the pound. That's got nothing to do with it. Now, the more black and white a trend is, the better, and I'm going to talk about that right now. Now, by black and white or shades of gray trends, what I mean is you can see on this chart the 4-hour USD CAD chart, June the 3rd, 2011. You can see that we have a distinct trend as evidenced by the golden cross back here, the 50 EMA punching up through the 200 EMA. We then subsequently have good angle and separation between the two EMAs, the 50 EMA above the 200 EMA, another indication that we're in an uptrending market. This is a nice black and white trend versus shades of gray. By shades of gray, I mean where the trend is not that obvious, and that can get you into a lot of trouble. A point here. Just remember that an important point in trading trends, as we are here, is to observe the attitude of MACD in relation to its trigger line. You'll notice that we have good angle and separation here. When we took this trade back here, MACD at no point ever penetrated through the trigger line to the south and maintained a good angle and separation between itself and its trigger line. And you'll notice also when you're trading a distinct trend as we have here with the USD CAD pair, you can see how predictable the price action is, okay? And what we're looking to do is to buy the dips in the uptrend. Conversely, if we had a downtrending market, we'd be looking to sell the rallies in the downtrend. Now, I'd like to make a special offer to you for taking the time to go through this video tutorial. Now, a big mistake that a lot of traders make is they assume that when you're trading the Forex that you have to be at your computer 24 hours a day, 7 days a week. Well, that's not the case, and we at forexmentor.com know a lot better. As a matter of fact, the only times that you need to be at your computer are listed on the left side of your screen. I want to pay particular attention to one particular time frame, noon Eastern time. This is the end of the London session. We have a member, Shirley, who lives on the west coast of the United States of America. She likes to trade the London close because noon Eastern time is 9 a.m. Pacific time, which is a good time for her to trade. It means that she has the rest of her day to do other things. So you can do the same thing. You could either trade the London Open, London Close, New York Open, or whatever, and we certainly will help you with that when you become a member at forexmentor.com. So here's Shirley. She has developed a way of trading the London Close for quick gains. It's a simple intraday strategy offering an accuracy rate of 90%, which is unheard of in trading circles. As a matter of fact, if you don't believe me, when you take advantage of this special offer, she'll show you exactly how she achieves an accuracy rate of 90%. And there is the link at the bottom of your screen. This is a special offer for you. forexminute.com/London close /. Just a note here that what we practice at forexminute.com is keeping it simple. And one of the simplest things you can do in trading the Forex is to trade market opens and closes. And what we're focusing on here is the London close that Shirley has developed a strategy for. Again, that's noon Eastern Time, 9 Pacific Time. And there's the offer at the bottom of your screen, forexminute.com/London close / get your hands on this special offer, and you too can trade the London close the way Shirley does and achieve a high accuracy rate as she does as well. That's forexminute.com /London close /. Just make note of that link, type it into your browser, and check it out. That's it, friend. I hope that this video tutorial has been instructive for you. And I would encourage you to go to www.forexminute.com and have a look at all the products and services that we have waiting for you there. So that's it for this video tutorial. I will be back on the air in 1 week's time to do another one, and I hope to see you then, friend. Bye for now.